Valuation for Startups. Prepared for and presented at the 2016 Square One Entrepreneurship Training Program. Square One is a program of the Center for Emerging Technologies. CET is an affiliate of the Cortex Innovation Community. Square One is funded in part by the Missouri Technology Corporation.
The subject tonight is valuation, and specifically valuation for startup companies, which is an important distinction, especially for a valuation professional. Valuation for mature companies is very straightforward. There's lots of history, there's lots of things to go about, there's lots of information you can find to come to a reasonable conclusion of value. Now, startup companies are a little different, and there's much more uncertainty. There's probably about as much uncertainty as you can have in a company. You're just starting out with an idea. You don't know exactly where it's going to go. So the idea with my talk tonight will be more about the concepts of value rather than showing you a balance sheet and a projection saying here's how you do a DCF, here's how you perform an adjusted balance sheet. It's more about thinking about the concepts of value, how people in my business go about thinking about value, how potential investors will think about approaching a potential investment in your company, and just those concepts. The truth is that the only truth in valuation is when you finally convince somebody to trade money for a piece of your company. That's the only time you truly know what your valuation is. Everything else is just an exercise in theory. And so it's always a negotiation. And so knowing the concepts and knowing how an investor approaches investing in startup companies can kind of give you an idea of where to come in value and help you in potentially negotiating a deal. Now, I've included an article here at the top, and I don't know if you've got these in advance and had a chance to look at it, but it's a blog article I highly recommend. It gives a very good outline of valuation during different steps in the arc of a company. Specifically, the arc of an early stage company. Now, valuation is going to matter to you in case you want to either give equity to somebody as far as compensation goes, or get a seed investment, let's say, and use that to run the business. But at the very beginning stages of a company, there's a difference in valuation and value of a company. Let's say you get a seed investment of let's say, what is it? Let's say $500,000 or $50,000 for 10% of the company. And you want to give up 10% for that. Well, that implies that the value of the company is $500,000, correct? And this should actually say post-money valuation there. That pre-money, that's an incorrect term for this. But that you'd have a post-money valuation of about $500,000. If this is a very early stage company, the chances of you actually selling that business at that point for $500,000 is very slim. So it's a valuation of $500,000 of the company for the purposes of that investment. It's not necessarily what you could sell that company for tomorrow. So it's important to keep that distinction in your head when thinking about valuation, especially when you're talking about it for fundraising purposes. Now, this article also includes a very large infographic that starts at the early stage of a company, and it goes all the way through an exit from a VC investment. I've only included the early stage portion of the infographic because I think it sums up a good. It sums up many of the pieces very well. on what people are looking at when you're trying to value a company, especially if it's pre-profit and pre-revenue. You know, they're looking at the intangibles that the company owns and that are present in the company. So they're mainly going to be looking at, you know, the team and the product and how much traction you have in the marketplace. So, you know, if the team and the product and the traction go together to produce the value and distill up into the value. And I think one of the interesting things about this infographic here is the Superman on the right-hand side of the infographic. And that represents founders and investors that have had success in the past on startup ventures and having successful exits in startup ventures. And you know, these entities that have these attachments to prior success tend to get higher valuations. People view those as being, you know, likely higher to succeed. It reduces the risk that they might fail completely. So folks who, you know, have been able to network their way through and get buy-in from very, you know, from popular folks in the industry or in the startup community, can look to reap some benefit from having those people on board. It just kind of raises the confidence of the investor community in their eyes. And early on, you know, the valuation might be typically based on how much money you need rather than the value of the company per se. You know, if you know that you need $100,000 to run experiments or to build a product or to build a prototype and to make yourself and to push yourself onto that next milestone to create value, you know, you're gonna need to ask for that $100,000, correct? So you ask for that $100,000. It's going to last you 18 months, let's say. So you know how much you need from an investment. If you're willing to give up between, let's say, 5 and 20% of your company in exchange for that investment, that implies anywhere from between a $500,000 valuation all the way up to a $2 million valuation, depending on how much you give up for that $100,000. Now, where you fall in on the scale of between 5 and 20 is going to completely depend on how well you can convince the investor that your venture will be successful and you will take that $100,000 and actually make that next milestone and be able to get your next round of funding. And typically, you know, that would be fast growth or at least success in whatever venture you're using the $100,000 for. Now, as a valuation professional, we're kind of held to a standard where we always have to take a look at the 3 major valuation approaches. And these are the cost approach, the market approach, and the income approach. And you know, the cost approach is essentially looking at how much money the venture has spent so far to date. You know, what investments in capital have they made? It's essentially a balance sheet based approach where you take the left side of the balance sheet and the right side of the balance sheet, restate everything to fair market value, subtract assets from liabilities, and you're left with the equity value of the company. The market approach is looking at comparable transactions, looking at what companies such as yours have fetched in the marketplace. These are typically change of control transactions. They typically represent the exits that the previous speaker was talking about with the VC exits, changes in control. So you'll find, companies in your industry have been exiting at, let's say, 8 times EBITDA, and that gives you an idea of kind of what you can apply to your company. But that's on an exit. The income approach is probably something that you've been brought up to speed about. It's typically a discounted cash flow analysis with projections, and then brought back to present value based on observed market rates of returns or required rates of returns, depending on what you can find for your industry. Now, what exactly is of value? And you'll see the list of things on here. Around the outside, those are basically assets that are of value. You have equipment, you have patents, you have trademarks, and you have process, basically know-how, trade secrets, those types of things. And then historical and future revenue are the more cash-based, income statement-based, value items. Now, all of this boils down to one simplified thing, and is that what is of value is cash flow. These items are valuable to the extent that they produce cash flow currently or represent an opportunity to produce cash flow in the future. For instance, equipment you have on the balance sheet right now, it's going to produce cash flow for producing your product, but also somebody stepping into your shoes doesn't have to repurchase that equipment. So they're avoiding a cash flow right off the bat. So everything comes down to cash flow, even if it's just looking at exiting the business. Taking a look at the cost approach a little more closely, it's essentially looking at an adjusted balance sheet. So it's taking the assets of your balance sheet, restating them to what you would call fair market value. If you have equipment, you take that equipment, it might be what you paid for it, it might be what you could sell it for, it might be what somebody else might be able to buy it for to recreate your position. Basically the principle of substitution. What would somebody have to do to put themselves to put themselves in your position? What kind of money would they have to spend to put themselves in your position? And so it's important not to exclude intangible assets in this, especially for a startup. Especially, let's say you have a software company and you've been developing the software for a year and a half. Well, that cost to develop that software should be accounted for in your assets under this valuation approach. So, for instance, if you haven't been paying yourself, as part, there hasn't been cash flow, you might not use actual costs. You might substitute what it would have cost you to pay somebody under your direction to get to this point, and basically see how much effort and cost has gone into putting your firm to where it is today. And then you can totally get a, yes?
I'm sorry, you can cut it off.
Oh, no, that's okay.
So would you consider intangible cost, like specific type of certification yourself or a partner or an employee you pay, like the amount of money that you bring in just based on them having a particular certification for your industry?
That could be. It could be. If it's providing value that's not, I mean, in the sense of this approach, this cost approach will typically be your floor value. It'll be one of the lower indications you're going to come up with. So I think that including that kind of cost, I mean, some people take whatever's been spent on the company to date, they'll just look at the operating expense items and say, we've spent $750,000 to date. That's going to be one of my indications of value. So definitely, if that's something that's an operating cost, it's possible that you could include that in there.
Right, like your operating costs, yes, so you pay a certain amount of money, you got the certification.
Yes.
But can you make projections based off of that particular certification? Like if you would not have had, or someone that's on your team, you paid for them to have it, then a percentage of that business that you want to get, like a projection, you couldn't put it in there because someone would need to have a particular certification. So could you consider that a part of like projecting how much income that you can get from certain revenue streams based on that, or is it just like?
That would come into the income approach when you'd be looking at, I mean, if you have to spend that money to participate in the market, then yes, that's basically an asset, and I would include it in there. And then obviously later on, when you're looking at a discounted cash flow approach, that additional income will be incorporated into your projections, hopefully. But more on IP, I mean, and the intangible assets, is that the problem with the cost approach is that there's no linear relationship between spending and the value of the IP. So that's where the cost approach kind of gets a little bit problematic. I mean, you might go and spend lots of money and come up with nothing of value, unfortunately. That's an issue. So the risk of wasted investment is high, but you could also, end up with something that is you can commercialize and ramp up into $1 billion industry. So just putting what it costs you to get to a certain spot, while it has a certain benefit in the logical sense, where you can say, I've spent X amount of dollars, therefore my business is worth X amount of dollars at this point in development. That's where it kind of gets problematic. Another way to take a look at it is to value the IP is to look at what a reasonable royalty rate would be for that particular property. If you can license it to some other company and perhaps get a 5, 6, 7% royalty on revenues that they produce using that technology, running a discounted cash flow off of those royalties to kind of value that IP and use that in your cost approach as well. Now, the market approach is typically dependent on having an active and current market in like transactions. It's a very direct method if you can find somebody as directly comparable to your company as you can, which can be very difficult if you're not opening a restaurant or an accounting firm. If you're opening if you have a company that's dependent on innovation and doing something new, finding that direct comparable is going to be very difficult. Also, as I mentioned before, the market approach, the data on the market approach is typically centered around exits. They're change in control transactions. So the data you're going to find are for much later stage companies in a lot of places. So you're looking at what happens 8 to 10 years down the road, not necessarily what happens today. So if you see an 8 to 10 times multiple of EBITDA on an exit, and you have a pre-revenue or a pre-profit company, 8 times 0 is still 0, and it's not even applicable. So it's finding a transaction that's at the same stage of development as your particular company, which is very difficult. Yes?
Can you explain the meaning of divorce in this context, the context of the transaction? Is that like the one part?
Well, that's a good catch. There's multiple reasons other than other than raising money to know the value of the company. Now, if you're looking at the value of the company for, let's say, divorce or litigation, you have a little more freedom, you have different, let's say, incentives on what you would prefer the value to be. So there's different incentives with looking at the transactions, and valuation is an art, not a science, and there's always a range. So you can end up either on the high end of the range or the low end of the range. Yeah.
So market approach would be great for a lot of IP related businesses, but unfortunately we don't have like licensing deals early on in the company, right?
Correct. You can look up some royalty information, and you look up what royalty rates are on some licensing deals, and find some of that information. I think there's a few databases that have that kind of information available, and you can see if you can find something similar enough, at least participating in the same industry, let's say, that shows what a reasonable royalty rate would be for IP that you might have. But then, along with that, you have to figure out what the revenue would be from that IP, and then apply the royalty rate to that revenue, and then back into what that IP is worth. The market approach, it's interesting because here's what you would come up with as, if I ran a search on biotech transactions, and these would be private companies. These would be private equity or private transactions. So this would be a private company getting bought by a private company. And you'll notice that the market value to invested capital to sales numbers, you're left with a very limited snapshot of what's going on in these transactions. You don't know what exactly is going behind the scenes, so it's hard to make adjustments on comparability unless you know exactly what any one of these companies are. And you'll notice, EBITDA multiples are rare here, not available. 132 times EBITDA, 7 times sales, 298 times sales. So these are typically strategic, and they're typically exits, and these are typically centered around the IP. So these are huge strategic investments. They're not already licensing the IP, so that's why there's no revenue, and that's why the revenue multiple is so high, is because somebody's going to buy it and they're going to turn it into the billion-dollar baby. So it's hard to use this to come up with the exact number, but it is useful to find out how active it is and also what the potential can be. This is the same general thing, except it is purchases of private companies by public companies. And you'll see a little bit, there's the prices might be a little higher. Public companies can tend to pay a little bit more than private companies will. And this is the same thing for internet software. I don't think I need to belabor the point, but it's essentially you get and here they're grouping together a little better, but you're looking at a sales multiple rather than an EBITDA multiple in many cases, because the EBITDA just isn't there. And that brings us to the income approach. Yes?
So is the EBITDA a function of the cash flow of the organization, and is that dictated by industries? If you're getting evaluated looking at your EBITDA?
Yeah, I mean, EBITDA is essentially earnings before interest, taxes, depreciation, and amortization. So it's a proxy for cash flow. It's a proxy for free cash flow, but it doesn't include reinvestment capital. if you need to have reinvestment capital, but it's essentially cash flow available to the management of the company to expand the business or reinvest in the business. So it's kind of used by a lot of folks as the indication of what kind of cash flow the entire entity throws off.
So the higher that number, the better.
The higher the EBITDA number, the better. And the higher the multiple, the higher the value of the company based off of that particular EBITDA figure. Yes?
I had a question, so maybe you could elaborate. For companies maybe more so that are post-revenue, they're already established, they're cash flow positive, but still have some upside either organically or as bolt-ons to other organizations. So in an environment like that, what kind of a role and how are gross margins looked at on the product lines and how are they considered?
Gross margins?
Yeah, product line gross margins or product gross margins. I've had investors, everybody always goes straight to EBITDA, and then I've heard, under those scenarios before, I have heard, some of the investor base speak about gross margins, and it's not as important, but why would you look at one? Why would you not look at the other? Where's the emphasis?
Yeah.
Where's the weighting?
Yeah, I think the emphasis on EBITDA is the fact that it's further down the sheet, so it encompasses more costs. So, the higher the EBITDA margin, the better you're controlling costs all the way through, including operating costs. So that, the EBITDA margin is going to include your gross margin. So it's kind of putting both together. It's looking at the gross margin plus whatever other operating expenses you have.
So if I'm understanding you correctly, then if a larger organization was looking to buy you and there was a compelling argument on their part that maybe their cost favorabilities would be such that all of that would go away,
Correct.
Then it sounds like under that scenario, as a bolt-on or as some kind of a joint venture partner,
That's
all
right.
of a sudden product margin would be very important.
That is correct, yes. Yeah, because if it's a bolt-on acquisition and somebody's looking at a company and they know all of the administrative costs are going to go away, the actual gross margin becomes much more of import.
Or even if it were a joint venture and there was some understanding on both parts that what the dominant partner brought to the table was just much more efficient internal infrastructure, then it would enable the other team to focus more exclusively on product. The margins would maybe be more important in that scenario.
Yeah, definitely. Yeah, especially in a manufacturing environment, the gross margin would be, at a premium. To move this into the income approach, it's typically, DCF approach. You're going to have projections. You're going to have, an expectation of future benefits and future revenue, and these are going to have to be substantiated. So you're going to have some idea of how many customers that revenue or how many units that revenue is, what the churn rate is, or what you're going to have to know what makes up those numbers. Because if anybody asks you about those numbers and the answer takes longer than they like, that immediately calls into question those numbers and might increase the applicable rate of return that they might require on those projections. Something as experts we look at when we're provided with projections are, do these projections make sense? We get the projections and we get the story behind the projections. Now we go into looking at what the story behind the projections is, and we see if this makes any sense with what we know about the industry, what we know about current trends in the industry, what's going on in the general economy. Can this happen? We're told by the company that this is what we think is going to happen, and the first question we asked ourselves is, can this actually happen? Sometimes it can, sometimes it can't. And then you get to figure out what kind of risk-adjusted rate you're going to apply to these discounted cash flow figures. And I think these rates are fitting in well with what the prior speaker kind of mentioned is the 40% rate of return that VCs are asking for on startup. And you'll notice in startup, you're at 50 to 70% across the board, with some outliers over here at 100%. And as you get further on down the line, what's required as a reasonable compensation for your risk kind of moves down until you get to bridge IPO level and you're at a more reasonable 20% level. You'll notice, if you can read the tiny print, that some of these are, slightly dated, 1987, 89, 98, 97. So you might be able to subtract a few percentage points from all of these just based on the general lower interest rate environment we have today. So you might be able to take 5-6% off of these and get closer to what might be a more reasonable range today. But there's also some work done by Pepperdine, the private capital markets project at Pepperdine, and they produce this every year, which they send out a survey to practitioners who are in the private capital markets, venture capital firms, and and ask, what are their deals being funded at? What kind of rates of return are they requiring on investments? And you'll see all the way over from the left-hand side are just bank loans, and then moving over, you've got mezzanine debt, and then there's private equity groups grouped by EBITDA size of company. But you look over here on the angel side of things, and you'll see angel seed, which is right here. I think personally I would have reversed the order, but you'll see that the middle 50% of deals that are done at the seed stage for angel investors are between, the first quartile is here. So that's what, 25% around about? The average is, up here, and then the third quartile is here. So the middle 50% are between 25% and about, 68%? Which is a pretty wide range. And that just goes to speak with the wide range of risks and the high level of uncertainty that exists when you're dealing with startup companies. Yes?
So how do the VCs determine the discount rate?
That is personal preference.
Okay, so there's no, like with big companies, capital asset pricing on
Correct.
cost of equity, after tax cost of debt, beta times the equity.
Uh-huh.
It's pretty simple to get within a range.
Sure.
This one here just did leave the cash flow.
Well, a lot of it is exit determined, where they know they need to make 10 times their money within 5 years. So they'll say, what kind of return do I need to make to get that to happen based on dilution?
So out of curiosity, is that part of the discussion? So when you say, well, I'm only going to give you 5% for 100, and they say I only need 20, do you get into the required return discussion?
I don't know how much you're going to get into the required return discussion, but there will be discussions about risk, about perceived risk and actual risk. The potential that you might end up with zero. What's the probability of that? Which is, it's always a potential. It's just how much of a potential is it? So that comes into play. So I don't know if there'd be explicit discussions about the return necessarily, but the justification of the size of investment for what they're giving up in money, I think, would be centered around risk. Yes?
This is going to add a little bit, because I'm a venture capitalist myself. So First of all, venture capitalists are typically at different stages, so you have to understand where your venture capitalist is within their life cycle. They used to be 10-year funds. They're still stated as 10-year funds. These days, they're not 10-year funds. For the most part, you know, you're 12 at the very least. You're probably somewhere like a 15-year fund. So you need to understand where venture capitalists are within that cycle. Have they just completed that fund and are just starting to invest, or where are they? You need to understand that. The second thing that you need to understand is what kind of other deals that they've made, because that begins to look at what kind of expectations that they'll have and how closely you may be aligned with some of those other deals. The next thing is you'll need to understand that they may not need that 10x kind of return. These days it's much less. 10x was in a great era, but typically it's not that high any longer. But they do want to understand your risks, absolutely. They do want to understand what you're thinking about in terms of exits. There's pretty much just a couple exits, but they want to understand how you're thinking and what kind of assumptions you're building into it. I think those kinds of discussions are much more important than I intend to exit in X number of years. Is that helpful?
So then the question is, you know, where do you end up on that continuum of possible discount rates? And it's basically a question of reducing perceived risk. So what does your founding team look like? You know, is there previous, you know, participants who've successfully exited that will tend to lower the rate? You know, are there near-term revenues expected? Have you exhibited near-term revenues? Has there been near-term revenue growth that's been, you know, promising? You know, that will tend to lower perceived risk. You know, what's the potential market size? You know, if you're working in a little niche market, somebody might be a little more worried about applying a low discount rate to your product. But, you know, if there's a potential that it's a billion-dollar market or a multi-billion-dollar market, you know, they might be a little more forgiving in order to potentially participate in that down the road. What does the competition look like? You know, do you have it cornered? The better position you have competition-wise, the lower the rate would be as well. You know, and then how much confidence, you know, is there in the business plan? Is it solid? Are they confident in how you go about your business? You know, do you get along well? You know, those sorts of things. You know, those all, you know, weigh into where you end up on the discount rate spectrum. There's also some alternative methods that don't really fall directly under any of those approaches. I think the venture capital method has been kind of covered already, which is basically, you know, you forecast what you might exit at in the future. You know, if you know you're going to exit it at, let's say, 8 times EBITDA, you expect EBITDA to be at 10 million. You're going to exit at 80 million. You're going to estimate what piece of the pie you're going to get, and you're going to discount that back at a rate of return that you feel is appropriate. So that was kind of talked about already. Another method is this First Chicago method, which can tend to be a little complicated. I find it useful as an exercise because it helps to articulate the risk of your company. You know, you basically have 3 projection scenarios. You give weights to each on the likelihoods, and then one's the best case, one's the worst case, one's just kind of middling along. The benefit is that you can play around with the weights and see what the risk-reward ratio looks like as you change those things, which can lead to some interesting discussions. The issue with that is instead of coming up with one solid projection, you have to come up with 3 projections, all of which have their own assumptions. And then in addition to those 3 projections, you have to come up with a likelihood of each of those three taking place, which is another level of estimation that you have to take into account as well. So, you know, there's pluses and minuses. And here's a method that just that was presented to me recently, and I believe it's been updated to include a little higher numbers based on the current market. But it's from David Burkus, who's an angel investor, and essentially it comes down to giving value for reducing risk. It has nothing to do with potential income. It has nothing to do with what projections are. It is strictly giving value to reducing risk. So there's basically key value metrics that he has. You know, does it have a cool idea, concept, or technology? And you get up to $500,000 for having that. So, and it's a very loose. It's a very loose rule of thumb. Do you have experience management? You can be awarded up to $500,000 for that. Do you have a prototype? Are you at the build stage yet? Strategic relationships. Do you have distribution? Do you have people on the advisory panels that can help you through this? Do you have your supply source locked up? You know, do you have a board of directors that can help steer you through some of these major decisions? Do you have paying customers already? Do you have traction in the marketplace? Which tends to get the biggest kick in his method. But basically, you go through there and you add all what you've awarded to people up, and then that's the valuation. Yes?
I have a question on this method in Chicago.
Uh-huh.
Would you recommend, because I noticed the first method, which is what we've been talking about the most, really works well if you have an actual tangible product. You are moving more towards that product's good and goods. But services seems to get lost, especially if you're a service industry that the information that you need to make projections is not readily available for you to, I mean, it's just a lot of assumptions.
Sure.
So would you recommend one of the other or service consultant company that may have some eventually revenue streams coming from a more tangible product? Or do you think it doesn't really matter in the grand scheme of things?
I think you can use any of these. Like when I say cool idea, concept, in this particular, it could be, do you perform a service in a unique way that gives you an advantage? And if the answer is yes or no. And it's also hard to give, it's the difficulty in giving a competitive advantage in a service business is it's always dependent on how well the service is performed to a particular customer. And you always have to perform for each customer to retain customers. So having a sustainable advantage in a service business is very difficult. It's very difficult to ascribe long-term value to unless there's a big institutionalized process around it.
But the value for a product is the same. If you don't keep a company's product, it would be something that isn't as, the quality is not as good. I mean, that's kind of like the same, equal, I think, for service and product.
Sure. Yeah. Yes.
Quick question about the Burkus method here. You said it's primarily for pre-revenue companies.
Yes.
Can you explain how you drive that with like having paid customers or traction happening?
Well, that's kind of why that has the biggest value driver, I believe, is that if you're using this for pre-revenue company and the company has revenue, albeit maybe small, that kind of, you're further on down the maturity line than it's typically used at. by this person. And I'm not necessarily advising any one of these last alternative methods. I'm just throwing them out there because, you know, if investors are aware of these and use these, it's useful to know about them, because that might be where they throw out some kind of offer. That might be where, you know, their negotiation points, maybe they're anchored on one of these approaches, and that's where their head is. So that's the best way to negotiate with somebody, is to understand where they're coming from.
By the way, I think this last one is particularly useful in terms of, you know, managing your own expectations a little bit. Because, you know, a lot of people who come, you know, with all enthusiasm, which of course we always, you know, encourage, but people come to me and they say, well, I think my company is worth $10 million. And there's, you know, just one person and an idea. You know, that's just not going to happen, right?
Yeah.
And, you know, so this, I think, really helps to crystallize that. And so I think it's useful for that purpose alone.
Also, it's someone that's fairly definite, do it in 2 minutes.
Yeah,
This is a yes or no for 6 things.
yeah, and if you're seeing, you know, if you're sitting down, and I think this is where he came up with it, if you're sitting down and listening to 10, 15 pitches in the course of half a day, that kind of helps you move through them pretty quick, at least in your head, and being able to give a quick yes or no and keep the process moving along. Other considerations is, you know, what the capital structure of the company looks like, what the cap table is. Does it include, you know, preferred debt? Does it include convertible preferred? You know, what does the capital structure look like? You know, and are there options carved out for compensation? Because the discussion so far has been the value of the entire company. And, you know, if you're down looking at what is the value of the, you know, performance shares that I issued to my CFO, you know, those are two different questions. Once you find out the value of the company, you have to figure out how it's allocated amongst all the different classes of the stock. So there's additional complexity in allocating that value amongst the different classes of stock, which is probably a little outside this discussion, but I just wanted to make sure that I mentioned it. And other than that, I think that wraps up what I have.